Hi everyone, my name is PK and I have Ash Jindal from ClearTax. He is a chartered accountant and also a registered tax agent. And we're so honored to have him on because in this episode, we're going to be talking about structuring and entities, how to buy your properties, etc., in the lens or from the lens of exit strategies. Four main points that we're going to cover. From comparing individual name purchases versus family trust versus SMSF, etc. How can you best dispose of your properties in the most tax efficient way? We're going to be talking about tax depreciation. Once again, the impact on the cost base, balance adjustment, and capital allowance recapture when it comes to selling properties. We're going to talk about, can I just transfer the property to my children while I'm alive? So once again, exit strategies from a legacy planning perspective, stamp duty, CGT consequences. And lastly, how are investment properties treated upon the death or transfer to children, after you pass away? Once again, CGT implications, etc., etc. I don't think I've talked about this or covered this in nearly enough detail in the past. And who better to have on than Ash, who is very, very, very experienced. He's also worked with a ton of my clients, and he's just an all-around good guy and someone who's actually qualified, unlike me, to give you tax advice. So thank you so much, Ash, for making time. We're very appreciative of you.
Thank you, PK. Thank you for having me on board.
All right, well, let's go. Which one of those 4 points do you want to tackle first?
We can talk about how do I dispose of my properties. I mean, what structures happens like when I dispose of my properties, what taxes are applicable to each of the structures. Um, People can have n number of structures. I would say three main or common ones are individual, a family trust, and an SMSF. So there are the three most common structures what have come across to me that are very popular in terms of holding the property. Now, when you dispose of a property in your individual name, you end up paying approximately the 47% tax. Now, obviously, you get a 50% discount on CGT if you hold the property for more than a year, which is mostly the case. But what I'm trying to say is there is no real planning can happen. Whosoever holds the property, they get that income, and they gotta, more or less, most of the people would make more than 200K, and if you weren't made more than 200K, then you kind of end up paying the 47% of marginal
You're
tax
saying
rate
200K in terms of the profit. So I'm just making sure I'm
after
not
the C.
confused. We're not talking about your regular income here. We're saying, look, let's assume you're making at least 200K or 180K or 190K, something like that, in terms of the capital gains that property's achieved.
Absolutely, after the deductions as well. So basically, what we are saying is, it's individual is the least preferred structure from a planning perspective, but a simpler structure. So if you don't know much, generally what people will do is just go and buy the property in the individual name. Obviously, there have pros and cons, but technically speaking, when you're trying to sell the property, that is where the biggest con comes in most cases, where you're hit with that 47% tax rate. Now come the family trust. Family trust is again, it's a tax planning tool, which how I see this. What happens is, let's say I buy a property today. My spouse is not working, and I got two kids, and the kids are below 18 as of now. And what happens is, when I'm selling the property, my spouse is still not working. I do have two boys who are above 18, but maybe in full-time college and stuff, and they are not really working. So it is possible for me to distribute some of that profits to my spouse, some of the profits to the kids as well, for the college fees and stuff like that, as because all of them could be the beneficiary in my family trust and pay the lowest possible taxes in the future. So again, all this is possible with the family trust structure. So that means I don't end up paying 47% tax for sure. I kind of or plan in a way that, if I have dependents, or if I have if I have members in the family who does not earn as much as I do, specifically between me and my spouse, I can then replan my structure in any ways. Yeah.
I'm just
So
going to
again,
ask like elementary questions, Ash, because I know
yeah,
that
yeah.
some people might know of them, so it might be a bit silly, but forgive me. Can you define what family means in this context. So I get it, like kids, husband slash wife. Does like a sister-in-law count or a
Uh,
first
Absolutely.
cousin?
So it all depends on how your family, how your deeds are written. It's called discretionary trust, right? And then we, in most common way, we say it's a family trust, but it's called discretionary trust. So at your discretion, so you're able to distribute the income at your discretion between your family members, including your spouse, children, as well as extended family members if you want to give them or gift them some money. It can be your siblings, it can be your parents, it can be your niece, nephew. So and the list goes on. Yeah, so you can define the beneficiaries, and then you can obviously, most of the trust deed in Australia are written in such a way that all your blood relatives can be part of the family, and then you kind of, if you are willing to, and if you're generous, you can then distribute some income to them as well.
Wow, I don't think most people know that. I think most people assume it's like immediate family, like husband, wife, kids kind of thing. I also want to ask a question, and sorry to put you on the spot. I know that every now and then in the Australian Financial Review, I see like news. I think I've probably seen it every year for the last 5 years that the ATO or the government is cracking down on family trusts and that, sometimes they're used to exploit the tax system. Is that just like clickbait, like news cycle stuff, or is there any substance to that?
I think the key substance to that is you are allowed to distribute the income to the family members, but you're not allowed to claw back. So what I'm saying is, if my mom is not working and I say, "Mom, can I give you 100K so I can reduce my taxes?" And what people used to happen is then mom gifts it back, so whatever that remaining taxes, and use it and this and that. So this is not allowed anymore. Well, this was never allowed. It's just they have made it more apparently that we're going to crack down on these ones. I
Oh,
mean, this could
okay.
be one of the, yeah, this could be one of the things. I mean, there are so many things that have been cracking down on family trust because the beneficiaries are not fully defined. It can be anybody really at your discretion. So so basically what they're saying is you gotta be we will track down if you do any such schemes in terms of transferring the assets and then clawing it back, or transferring the profits and clawing it back just to save on taxes, or as a gimmicks and stuff like that. Yeah.
Got it, got it. So you have to be careful, I guess, and not like distribute income to your mom and then like the next day she like sends it to your bank account. Like that's a bit dodgy.
Yeah, and that's what they don't want. Yeah, of course, they want, if you are willing to distribute, for example, if I'm distributing to my kid, for college fees and stuff like that, that's all okay. But if I'm clawing the money back, that's again, it's not okay.
I understand. Okay, cool.
And the kids have to be above 18, guys, if someone is
Is
listening to
there
this.
any way to distribute it to them if they're under 18 and kind of put an embargo on it or hold it?
Um, uh, not in simple terms. No, it's only about $400 what you can distribute to the kids, um, but no, not in simple terms, because it does get a penalty rates and stuff like that. Yes, it is possible for you to park the money in a bucket company and then distribute the money, but then again, it can get into the complexities and stuff. And for this podcast, probably we'll keep it simple. Yeah.
Got it, got it. All right, perfect.
And then, sorry, the last one is the self-managed super fund. So if you're holding a property from a self-managed super fund, if you sell within 1 year, you pay 15% tax on the capital gains. If you sell it after 1 year, you get a 33.33% discount on it. So effective tax rate becomes 10%. So 15 minus 33.33%, effective tax rate or CGT rate becomes at 10%. So for example, if someone has bought the property today for 500K and sold the property after 5 years for 800K within self-managed environment, and they're age 40 and now they're 45 and they sold the property, still working and everything. So they've made a 300K of capital gain. So maximum tax that is applicable to them, it's $30,000,
Right, right.
right?
This
From a
kind of
self-managed.
a it's kind of a tricky question and like
Yep.
complicated. Maybe it's outside the scope of this episode. But let's say someone's about to retire. Like it would obviously make sense to hold on to, and I'm talking about SMSF here.
Yeah,
It
yeah,
probably
yeah.
makes sense to hold on, formally retire as per the ATO, and then if you wanted to sell that property, sell it then, as opposed to sell it before you retire. Is there any difference in how the tax treatment occurs?
Absolutely, PK. So if you sell the property in a pension phase, you pay, and most people would pay 0% CGT. I mean, there are some limits to it, but most people will not break it. But the point, for simpler way to say that is, it is possible if you buy this. Let's say if you buy the property today for 500K, and you sell the property when you are age 70, and that property is now $1.5 million after 25 years, that entire $1 million is possible to have as a tax free. So there's no CGT or zero CGT on that. Yeah.
Yeah, that's pretty amazing. And I think that's why I don't know if you are also seeing it, but at least in my perspective, the last 3 to 4 years, the popularity of SMSFs has grown and grown and grown so much. I think people need to be a little bit careful because the tax treatment is changing for those with a SMSF balance above $3 million, and there's some funny things going on there, but. Yeah, it's a fantastic tax effective vehicle, but just get professional advice if you think you're going to exceed that $3 million benchmark.
Absolutely, absolutely. And that's about it. How do you, so you kind of understand your three most common structures, and you kind of understand what happens when you are trying to dispose, what sort of options are available to you when you're trying to dispose in individual, family trust, and SMSF.
Got it, got it. Let's move on to the next one. And everyone who's watching or listening, if you have any questions or if you have like any further topics that you want maybe Ash to talk about, put them in the comment section, like on YouTube, and then maybe in the future I can do another session with Ash down the line, and we can cover those topics. So, to have this kind of one-on-one conversation with an accountant who isn't going to hold anything back normally costs a lot of money. I don't think many accountants will sit down with you for hours and go through all these things, especially in a very silly way, in the way that I'm asking. Because let's be honest, most people have these questions, but I think they're so stupid to ask them, but I'm asking it on your behalf. So I want to bring you as much value as possible. If you have topics that you want me to cover, put it in the comments, and then maybe we can have Ash cover them in a future episode. But we just got started. Let's carry on. Let's go to the next section, which is around what happens to depreciation deductions, your tax depreciation deductions when selling.
Right. So um, without making it too complicated, there are two types of deductions that you can claim whilst you're claiming depreciation, which is Division 43, which is a building and or capital works, and Division 40, which is a plant and equipment. What happens is, generally speaking, you would apply a fixed rate method to claim Division 43, which is around 2.5% of the property or asset life, and then you apply a maybe an accelerated route to claim your Division 40, which is plants and equipments. When you are selling the property, it's kind of your cost base for Division 43 is reduced to a certain extent. So let's take an example, and that would be really helpful. Now, if I bought a property for 500K, let's say 50K it's for plant and equipment, and 450K is for my building. After 10 years, if I'm selling it, if I've claimed, obviously I've claimed the depreciation on it. If I've claimed under Division 43, if I've claimed my capital works deduction under Division 43, my 450K will reduce down to, I don't know, could be, so I've not done the calculation, but let's take an example of it reduced down to 430K. So my cost base for that property, it's not 450K. My cost base for that property is 430K. And we're going to talk about plant and equipment in a sec, but my cost base for 400 for that property is now 430K. So that means if I'm selling that property for $1 million, I got to pay the capital gains on that 530K or 570K, right? Okay, now I'll come back to plants and equipment. The way the plants and equipment form is, and then obviously I can apply the 50% discount on that, on the capital gains as well. And then now the interesting thing about plant and equipment is it does not form part of that 50%. It does not form part of that capital gains. So that means you do not get a 50% discount if your plant and equipment has gone up in value. So which means, let's say you have a 50K of plant and equipment and you have held the property for 10 years. and assumingly you've claimed everything on plant and equipment, right? Because it's 10 years, your dishwasher, your air conditioner, and everything is fully depreciated. And now you're selling the property. Technically speaking, you should do a quantity survey report before you sell the property so that they can differentiate between what's the current value of plant and equipment. So if the plant and equipment is not zero, possibly it's not zero because the air conditioner is still in operational, your dishwasher is still in operational, you got to do the balancing adjustment because you've claimed the 50K of depreciation of plant and equipment over the 10 years. And if now it values to 20K, you gotta add the 20K into the gains, into your income. And there's no CGT discount on that. You know what I mean? So basically your division 43 or your building helps you to reduce the cost, whereas division 40 plant and equipment actually raise a capital gains. So technically speaking, I think so when you are selling the property, it's important to understand what deductions you have claimed. You kind of reduces your cost base for building buildings or capital works, whereas plant and equipment requires a balancing adjustments. I hope it's
Got
clear,
it.
PK.
Yeah, I think
Yeah.
so. I think so. I think, often I talk about how depreciation, it's great. It's like a bonus for property investors where from a cash flows perspective, every single year, because the building is depreciating, it's a non-cash expense. Doesn't actually cost us any money, but it reduces our taxable income, assuming you've bought it in your own name. So that's a great thing, but it's not free. When you sell that property, to the extent that you have claimed building depreciation, to that same extent, your capital gains liability will increase. Now, of course, there's the capital gains discount applied on that, but I think you've made a really interesting delineation between plant and equipment versus building. And the other thing that I picked up was to get a quantity surveyor. Often we get quantity surveyors when we settle the property because we want to figure out how much we can depreciate. We're like really keen to do that to reduce our taxable income. But when you sell a property before you do so, it's really important, am I hearing you correctly, to get a quantity surveyor for the plant and equipment side, not necessarily the building side?
I think it's everything. Yeah, it's good to have for everything, but mostly for plant and equipment. Yes.
Right, right. Okay. And is that essential to have done before you sell, or could it be done retrospectively as well?
I think it's good to have it because they would want to survey the building, so they will not have access to the building once the property is sold.
Okay, so before you sign, the buyer signs the contract, you should get that done. Try to avoid doing it between, when the property is conditional and settlement. Best to get all that stuff done ahead of time.
Yeah, as long as the surveyor has access to visit the building, I think it should be okay. Yeah.
Okay, cool. Anything else on that topic?
No, it's just remembering as PK said, just you cannot ignore the fact that every single deduction that we are claiming in our tax deductions when we are selling the property, I think the gist from it is when we're selling the property, everything needs to be accounted back.
Yeah,
So
yeah.
yeah,
There's no
yeah.
free lunch. It's like a
There's
discounted
no free
lunch,
lunch.
but
No,
it's not
no.
a free lunch. And I think it's very important to know because a lot of people try to sell you brand new properties off the plan apartments and they sell you the depreciation story and they sell you how it's because of the tax offsets that this will become positive cash flow. And that may or may not be true in the short term, but in the long term, you got to pay a lot of that back to the ATO. There's no such thing as a free lunch. Let's move to point number 3 now. Can I transfer the property to my children while I am alive? Okay, so what are the consequences of that? Is that free? Is what are the intricacies involved in that?
Right. So it just feels like it should be fairly simple for me to transfer the property to my children without paying taxes or anything, but it's not that simple. Interestingly enough, it's mostly seen as you're selling the property to your children. Now we're talking about investment property for now, and we come back to PPOR if required to. But let's talk about investment properties. So if I have maybe let's say 4 investment properties, I have 2 kids. I want to give one investment property to one kid, another one to another one, and then two just keep me and my wife as a retirement. If I'm if I want to do that whilst I'm alive, it will be seen as a deemed sale to a third party. So that means I will have to pay the capital gains tax that is liable for me, and they will have to pay stamp duty whilst they're buying the property off me. So even if there's no cash involved, it will be seen as a sale at a market value. And I got to do the proper valuation done before the property is sold at a below the market value or less than market value. If it is sold at market value, that's fine. But if it is not sold at market value, I must get the proper valuation done and stuff like that.
Is that like a ATO regulation? Like, let's say the property is worth, I'm just making this up, like $1 million. Like, it's
Yeah.
not uncommon for, because the real estate is an inefficient market, sorry, inefficient market. Sometimes people buy properties $50,000 under market value because it's like a divorce or, there's like a fire sale, there's some sort of
Yeah.
distress on the seller side.
Yeah.
So in this context, where let's say I want to transfer it to my son and I'm like, it's worth $1 million. Try to reduce the stamp duty, etc. Sell it to him for 900K. Is that going to be like, is that illegal from an ATO perspective?
I would say so, yes, that's illegal. Because the thing is, when you're buying from a third party, they're not related, right? Then, yeah, market principle applies, and that's fine. You can still negotiate and you can do this. But when you are selling within the related party, that is what it raises a lot of concern. And specifically, when you are selling at below the market value, you must get the valuation done. And that valuation will give you obviously a lot of comfort to you that at what rate you're going to pay the stamp duty and everything. And obviously, no one wants to lose the money. ATO doesn't want to lose their money because of the capital gains, because you will pay lower capital gains if you sell at a lower rate. And stamp duty, obviously, state revenue will also lose their money. So they don't want to lose the money. So if you are doing that, obviously, it will raise bars and alarms in the ATO system saying, what's going on, guys?
I know people will be watching this and or listening to it and be thinking like, what about a donation? Aren't you allowed to make like a tax-free donation to your kids or family members? Is there such a thing in terms of if let's say I have $1 million cash, right? And I'm like, I want to give it to my son. Obviously, I can do a donation, right? I don't need to he doesn't need to pay tax on it. So
Mhm.
just humor me for a while, Ash. Why is that not possible for a house?
Right, of course, yeah. So I would not call it donation. I will call it as a gift. So you can gift a
Sorry, a
million
gift.
dollars.
My
Yeah, no,
mistake,
that's
right?
okay.
Yeah.
That's okay. No, that's okay. So I would call it a gift. So yes, you can gift $1 million that is sitting in your bank account to your kids, no problem. Because the house is not the same as a $1 million, because you have made an income from a house, but nobody has paid tax on it. The $1 million sitting in a bank account, somebody would have paid tax on it for that money to sit in your bank account. So that's already a tax paid money. But when you're transferring an asset, that asset has appreciated and no one has paid tax on it. So obviously, ATO wants to have their pie and state revenue wants to have their pie. So if yeah,
Right.
so
And
that's the difference between, yeah.
is that also the case? Like if I own it in a, yeah, no, that's a stupid question. I was going to ask if it's in a trust, can the trust give a gift? But no, I'm going to retrace that because I realized how dumb that was. Other question is you mentioned PPOR. Is it the
Mhm.
same rules apply if I'm talking PPOR versus investment property?
Yeah, slightly different, slightly different. So, and obviously, guys, we are just talking about will's time alive, right? We are not talking about
Yeah.
inheritance. We're not talking about at will. We're just talking for now. We're just talking about will's time alive. If I'm transferring my PPOR to my kid, it's likely then I will be exempt from CGT, and my kid is going to use this PPOR for investment use and stuff like that. So I won't be paying any capital gains tax because it's exempted, because I can sell it to anybody at market value at a 0% CGT, whether it's a kid or anybody else. So no capital gains tax when I'm selling my PPOR. Presumably, it's my PPOR throughout my life or throughout the life of the asset that I hold. Now, when my kid is buying it, yes, the stamp duty would be applicable for that. Yeah.
Right, right. Got it. Anything else on this point before we move to the fourth point?
No, no, I think so. We have covered it. Yeah, nice and tidy.
Okay, I like it. We're very efficient, I think. And then number four, how are investment properties treated upon the death or transfer to children? So before we talked about whilst I'm alive, now let's say I've passed on. Let's maybe cover investment properties, and then if you're okay with it, let's also cover PPOR.
Absolutely, absolutely. Now, this is slightly technical, but I'll try to make it simple. Um, Assumingly, the investment first, let's talk on investment properties. Let's say I have four investment properties. I'm gone. and I'm a single parent, two kids, and I'm gone. And there are four investment properties. So technically speaking, these four investment properties I would somehow want to be transferred to my kids. If that is the case, and these investment properties, most of them are bought after 1985, to be precise, after 20th of September 1985. But let's assume it's after 1985, I bought these properties. Now, I can transfer this property. Sorry, this properties can then get transferred to my kids at the cost base of of the date that I've purchased the property. So let me take an example. Let's take an example of one property. I bought the property in 2025 for 400K. I have transferred at the time of death, the property value was 900K. Okay, so I bought this property in 2015 for 400K. At the time of death, the property value was 900K, and it got transferred because obviously I'm not there. It, as a part of my will, it got transferred to my eldest son. Now, when this property got transferred, and imagine if my son on the same date wants to sell that property, he will have to declare a cost base of 400K only. Now, it's not transferred at 900K at a market value. So technically, I'm not the one who's paying the CGT. He's the one who's paying the CGT.
So the ATO still makes their money. It's just a case of who pays.
Yeah. So you're just deferring. So I know we heard about there's no death tax in Australia and this and that, but in this interesting scenario, we see that death tax, it's kind of getting deferred to my son. In the case of investment property, right? So that
but
means
no stamp duty, of course. That at least we
no stamp duty. Yeah, that is good. Valid point. Yes, no stamp duty on transfer. But yes, it does get capital gains does get, or federal taxes gets paid, which is a capital gains, right? Now, if my son has hold on that property and sold it when the property value was 950K, then 400K minus 950K is the total capital gains. Of course, and if they hold the property and stuff like that, they're also applicable to apply for CGT discount, which is 50%. But but I think we get the gist that the cost base gets transferred with the death. Okay. Now let's assume the property was before 1985. I think very few scenarios left for that, but let's assume that I've acquired the property before 1985 and then I've transferred the property, which is pre-CGT era, and I've transferred. At the time of death, the property get transferred to my son. If that happens, that property gets transferred at a market value.
Okay, so for those people who bought their principal place pre
not investment property.
1985, investment
we just talk about
property.
investment property. Yeah,
Okay, investment property pre 1985, then it is actually marked to market. Then yeah, got it.
Because when you were buying the property, there was no CGT principle there, and then obviously the rules are defined in such a way that if you are pre CGT even, then yes, you can transfer that at a market value, and then obviously whatever gains the children are going to make, they're going to pay CGT on that. Now, let's talk about PPOR. When my PPOR gets transferred to my children or child, that PPOR gets transferred at a market value because there is no CGT to be paid by me. Because irrespective, when I sell the PPOR, it's not applicable for a CGT, provided I've held the PPOR through its life. So there is no CGT payable to me anyways, whether I sell it at death or whether I sell it before it. So that means ATO is not on the losing end. So it gets transferred at market value. Obviously, any increase. Now, children do have 2 years to sell the PPOR with no CGT event occurring. So that means they still have this 2 years limit to sell the PPOR with no CGT. But if they held on, obviously they will be liable to pay.
Oh well, so even if they held it and made it an investment property for 2 years, there's still no capital gains tax, even if it was an investment for 2 years, or only if it remained a principal.
Even if it is an investment for 2 years, but within that 2 years, they are allowed to sell that property.
Wow, I did not know that. That's pretty. Oftentimes the children, they would do like a fire sale, of any inherited property because they just want to not deal with it, and oftentimes it sells for a loss. But if it's in a location that's rising in value and booming, then there's a case to be made of just holding it for at least a year and
Yeah,
renting it out because you might get 100, 200, 300, $500,000 more for it in 1 or 2 years' time without
absolutely.
any CGT implication.
Absolutely, absolutely. And then if my child started to live in my PPOR, then obviously that becomes their PPOR. That means no taxes to be paid
Right,
by them as well in the future as well, of
right,
course.
right. Can we talk a little bit about a testamentary trust? So we talked about PPR just now.
Yeah,
Before this, we talked about
yeah,
investment properties and how they're treated upon
yeah.
the death, of the initial owner. Um, from a inheritance perspective, is it more beneficial to hold investment properties in a trust structure? Um, yeah, or does it not really make sense? And how does a testamentary trust feed into all this, into the mix?
Right. So the for so let's these are two separate topics. So we'll talk about maybe it's is it more beneficial to hold the investment property via trust structure. There are pros and cons to the to the trust, but let's talk about some of the reason why people opt in for trust, especially people with the families, people who know that they will have a partner, they will have kids, or they already have, and the kids will have further families and stuff. It is generally a solid reason why people buy properties in a trust, because let's say I got four properties and in my individual name and four properties in a trust. Imagine whilst I'm alive, and a lot of people are looking for it because it, let's say I'm alive till 80 or 90. If I hold on to all my assets and wait for the death to happen, then my kids are already 60. They
Okay.
might not desire to have that assets. They won't want to have an asset when they can grow, and when they're 40. In their 40s is what, I can be assured that they are sensible. I should be able to transfer the assets. Now, if I transfer it too late, it's not beneficial for them because they're not able to build on anything. So what people do, what I've seen people do, is they actually transfer the asset during their life, which means they will have to pay capital gains tax as well as the kid has to pay a stamp duty. Now,
Hmm.
imagine the same properties in a trust or a family trust with a corporate trustee and everything. You can then transfer the control of the asset to the kids fully and not pay and not pay the CGT and no stamp duty involved. So
Right.
it is possible for you to. So if these properties are in a trust, you can, yes, transfer the control to the kids, and the kids fully then controls the property, not you. And that's how you can you can basically skip paying the CGT and the stamp duty from as compared to what you would if the properties are held in an individual name.
Got it.
Right. So not many people think about it. Yeah.
Yeah, it's the trust seems gives more flexibility whilst you're alive in terms of distribution of income, but also in terms of sounds like a weird term, but like death planning, whilst you're still alive, it gives more fluidity to change controllership or control of that asset to your kids whilst they still are young enough to actually benefit from it.
Absolutely. And that, sorry, now we can talk about the testamentary trust. So, testamentary trust is basically you set up once at your will. So, basically, it only gets set up after your death. It cannot exist before it. It can only set up after your death. So, through your will. So, basically, um, your assets gets transferred to a testamentary trust and or your estate, and your testamentary trust then controls it or manages, and your through your executor and stuff. The key advantage of testamentary trust, which is unheard of, a lot of people do not know about it. Well, not really unheard of, but a lot of people do not know about it, is it is possible to distribute the income from the testamentary trust to the children as well who are below 18 and still claim the adult thresholds.
Oh,
So that means if I'm gone, I, my estate now is into testamentary trust, and my estate is making income, and I've lived a lot of wishes there. I have grandkids, and I have children, I have grandkids, and some maybe niece nephew, and they have kids and stuff. It is possible for me to, specifically for my grandkids, it's possible for me to give them income year on year till the time, obviously when they're 18, they already get a threshold. But let's say there's only one of the babies only 1 year old. It is possible for me to give the income, a good solid income to that 1 year old till the time they're 18 or start their making income, and also pay very minimal tax, applying the adult income thresholds, tax thresholds. So that way the testamentary trust can be very, very powerful as a part of your estate planning.
Right. Whereas in another case, if you're under 18, the tax thresholds would be much higher, like above the adult tax thresholds. Is that what you're insinuating?
No, no. So you by default get an adult threshold. So if you're above 18, you don't get any additional thresholds. All what I'm saying is, if you are below, I mean, it's just one of the examples of how testamentary trust can be really beneficial. I mean, there's so many other examples. Let's say, let's say I straight away transfer my asset to my adult kid, and he's going through a very disturbed marriage, and they're about to get separated. Moment they have this assets straight away to them, then obviously it will go into a family disputes and stuff like that, right?
Yeah.
Divorce case and stuff. It's part of then his ownership and stuff like. But if it is a testamentary trust, my executor can decide when the asset needs to be going into bloodline.
Oh, I see.
Yeah. So a lot of planning techniques can be done within the testamentary trust as compared to if I don't have one.
Got it. Got it. Really interesting. I think in my mind, I'm trying to create a matrix of like different scenarios and the different entities, but then I don't think it's possible, at least not for me, to like just store it in my mind. It's super helpful to actually study this and create a matrix and get professional advice. Because oftentimes in terms of my own tax agent and I have different financial affairs around the world, sometimes I think I know what's going on, but then they say, well, in this unique case, the this thing doesn't apply, which applies for 95% of other people. And so therefore you're either benefited or not benefited. So I think all this information is like super, super useful, and it helps create a framework in our mind so that we can go to our accountant, our tax agent, and our, accountant that we work with and ask the right questions. Because sometimes if you don't ask the right questions, you don't always get the right solutions. So I'm always a big fan of property investors or people in general in terms of their finances. They need to be the captain. It's not that you go to the accountant and say, tell me what's best for me. You need to also drive that ship. And of course, the accountant is an expert in their field, but make sure you understand what they're doing and you understand it. You can ask the right probing questions. I think that's really, really essential. Ash, is there anything that I didn't ask that I should have, or any points that you wanted to cover that we haven't yet?
No, I think I'm very happy with what we have covered. Maybe there's a lot to take on from these points, guys. I mean, if you have anything that you want to know more, please reach out to PK and or me directly, and very, very happy to add value to that.
Yeah, you can reach out to Ash at cleartax.com.au and his email. Should I give you your email here?
Feel free, yes. Feel
Okay,
free.
his email is ash@cleartax.com.au. Of course, always be respectful of different professionals like Ash here, different brokers, etc. that I interview on these episodes. They're very, very busy professionals. They're very good at what they do. So please be respectful, of course, goes without saying. Ash, thank you so much. I think this was really useful. I might need to get on the phone with you later and hash some things out as well, but I really appreciate you making time for the community.
Thank you, PK. Thank you for having me.
And thank you everyone for watching and listening. You might want to listen to this one again if you didn't quite follow everything. I think that's probably what I recommend to myself as well. Very important stuff that you don't necessarily just get from a Google search, or even if you ask ChatGPT, oftentimes, 20-30% of the results will be incorrect. So some of these things are very important, very sensitive. You got to go to the professional to get the right answer. My name is PK. Hit the subscribe button, give it a like, and I'll try my best to continue adding value to you guys. Catch you later.